Good afternoon, everyone. So lovely to have you here for day 3 crypto. Now, in this session, we're going to explore how fund managers are not only looking at digital assets as an asset class, but also looking to blockchain in order to strengthen their own internal processes. Now, my name is Gabrielle Inzerillo. I'm a financial regulator here at ADGM, and I'm so pleased to welcome our panelists. Hello. So, closest to me, I have Dan Donnie, CEO and co-founder of Securency, a blockchain-based financial services infrastructure company emphasizing compliance. We like that here. Then, to his left, we have Hervé François, partner at InvestCorp, specializing in blockchain and digital assets. Xian Chan, global head of digital assets for the private banking and wealth business at HSBC. No intro needed, big name. And finally, last but not least, I have Gautam Sharma, CEO of BH Digital, the crypto and digital asset division of hedge fund Brevan Howard. Welcome, gentlemen. So happy to have you here today to discuss this exciting topic. Now, I asked one thing of you today in the 20 minutes that we have, and it's actually a bit of a big one. Let's try to make this conversation a little bit spicy, but only as spicy as you can do, with billions of assets under management without alerting me and my fellow regulators. But let's try to make it interesting. Okay, first question. Let's stick to TradFi for now. Let's not go crazy. But where do you see blockchain actually fit into managing assets? Managing assets the way we know and the way we're used to them. There's been a lot of talk about efficiency provided by blockchain and clearing and settlements, etc. But are those true use cases? And I'm going to start with you, Dan, because you're right next to me. So you get first dibs.
Thank you, Gabrielle. I appreciate it. Yes, it's very real. So a big breakthrough for Securency this past month, we received SEC approval for our partner. Our clients are major institutions, for example, State Street, US Bank, and an asset manager, WisdomTree. They received SEC approval for a 1940 Act fund. So this is arguably the most conservative regulator for the most regulated asset, being approved for tokenization of a fund backed by treasuries. This is certainly one of the top 5 moments in blockchain this year, in a year that's been full of positive and negative developments. So we're very excited about that breakthrough. So you made the point of what does that mean in the end? Well, these assets, WisdomTree is launching in beta a tool called WisdomTree Prime. The first 3 assets are tokenized dollars, tokenized fiat, tokenized gold, which is custodied at the HSBC, and tokenized treasuries custodied at State Street using our core platform. These assets, as you trade the assets, retail investors have access to these assets. And as they trade or transfer, the actual transactions settle in T plus 3 to 5 seconds. So it's an instant settlement. You can trade. I can transfer gold directly to you. I can trade gold for treasuries, etc. This will be followed, as we've got this approval, by a whole range of other exposures now that we've finally broken the ice. So it's an exciting moment for the blockchain world, for regulated digital assets on these blockchain rails. And it is real. And customers get the real benefits from this technology.
I'm looking at you, Xian.
Me?
Yeah?
Hey. So I think, just to follow on from you, I think that's quite a tough act because I think you've nailed all the key points. But I think when I think about the real utility or the use cases that we want to focus on, and just to be clear, we're very much primarily in experimentation mode at the moment, although we have had 1 or 2 launches this year in the digital asset space more broadly. There's 3 broad things, particularly in my world, around wealth management and private banking. The first one is opening up investment access, and as you said, tokenization does that by potentially lowering minimums for asset classes that may historically or traditionally have had higher entry points, so private equity, venture capital in the fund space, real assets, real estate are good examples of that. The efficiency point is the other one, right? Albeit, I would say, I think that one I look at quite carefully because my personal view is that traditional capital markets in many ways, for example, in the equity space, actually works pretty well. It's complicated, but it's actually quite efficient. But that's one lens to look through. The other one is, of course, liquidity, which in my own view, I think has yet to be truly tested yet. It's the idea that if you tokenize, you can have a secondary market around some of these things. In kind of all my conversations, and of course I'd love to hear my fellow panelists' views, I believe that's yet to be seen. I think liquidity on a secondary and in the digital asset space, from what I can see compared to traditional exchanges, actually isn't quite yet at the same kinds of levels. But nonetheless, hypothetically, that's definitely a benefit. So those are the lenses in which we look to articulate use cases.
I'm going to just stay with me for 1 second. Do you feel, because you're in the wealth management space, do you feel your clients are excited about having tokenized products? Do they want to know about it, or do they not want to know about it? They don't care what's under the rails.
100%, and that was maybe the other point I would have mentioned. I think that there is kind of what I call, I'm an old school investment guy, what I call non-investment alpha, right? It's kind of this, the gimmicky stuff, right? It's a natural interest. They read about it, they buy NFTs, particularly our most valuable private banking clients, right, who are very involved in the art world. They see NFTs becoming a big thing, and consequently, that's a very good way to get interested in the topic. So you're right, there is a big natural interest, and that is definitely something we do have to cater to, because if our clients are interested, then we do have to look at it.
Okay. Now, going away from the retail side, Hervé, do you want to?
I wanted to add something.
Oh,
As
go
was
on.
not mentioned, but beside the efficiency, cost cutting, and other. We didn't mention the fact that the tokenization of assets enable like a different distribution channel, which is interesting for both sides. So on one side, for the investor, thanks to the fractional ownership, the entry ticket will be smaller is smaller like for those tokenized assets. But that's also very interesting from an asset manager point of view, because we can have a wider reach of accredited investors that can come and put their fund.
Very nice.
On this point around application of blockchain technology, I think while we are talking about traditional assets, I think it's pretty much relevant even for crypto and digital assets funds. So from my vantage point, running a digital assets fund, especially what happened in the last 7 to 10 days in this space, I think it also demonstrates the need for transparency and immutability of the data and settlement needed, especially as it relates to the kind of counterparty risks that exist in this space. I think the application of blockchain technology in itself is so important. I think even more important than TradFi in my view right now, given we already have trusted third parties in the TradFi space, which is right now lacking in digital assets. And this concept of prime brokerage is still very early. So we can really put blockchain technology to use in crypto itself. Much more than just trading assets, but also from a settlement perspective.
I see. I mean, we talked about how there's maybe smaller ticket sizes to actually get a bigger, broader range of people into certain types of assets. But I have to say, especially, for a number of you, you're still handling with an enormous amount of money from institutional investors. So where do they expect this, these digital products to come from, these digital asset-backed products to be? What do they want from them? And I ask this because I remember a few years back, there was all this hype because there was, for instance, the first sale of like a property fully done on chain, et cetera. And people were like, okay, this is going to be easier to like sell assets and sell real estate, et cetera. And it never really democratized or carried on forward. But what are institutional investors asking for now? Whoever wants to go.
Yeah, I'll start.
Yeah? I like it.
And what's exciting about developments in the blockchain space is the fact that there is ultimately no difference in the fundamental mechanism between retail investors and institutional investors. So I'll say again, as we've tokenized treasuries, treasuries are a foundational element in many, many transactions. So for example, repo transactions, there's trillions of dollars daily in repo transactions that involve treasuries and cash. Treasuries are the baseline for most securities lending, et cetera. In tokenized form, you can actually automate those processes through smart contracts. So now that we've finally broken the ice and we've got tokenized treasuries, retail, publicly available tokenized treasuries, we can then automate the rest of these processes. through smart contracts. And it's really a watershed moment for our client, WisdomTree in this case, and their institutional clients. What's exciting really in this new development is those same treasuries, a retail investor can take their $10 worth of savings, get better than their savings account interest on the treasuries that they're holding in tokenized form, and convert them to cash. We've bolted onto the Visa rails, and so you can buy coffee. So you can do a $100 million transaction that clears in 3 to 5 seconds, or you can buy coffee and it clears in 3 to 5 seconds. You can't do this on traditional institutional rails by themselves. So blockchain is a powerful enabler.
Okay.
And that to one extent, to echo on what you're saying, that enable like a diversification of the portfolio because you have a wider access to product. So institutional are also in search for like capital velocity or to maximize without being stuck by having a different type of investment. And especially also in that space, to an extent, you can comment maybe, we can have a yield, higher yield return, where the market always in search of a good yield.
Very nice. I do think, so as you know, evidently digital assets are a very broad asset class. You know, we have virtual assets, we have tokenized securities, etc. There's evidently different ways of distinguishing these different type of instruments, but where do you see the development of the space? Do you think we're going to be asking to tokenize everything as we go forward? Are your clients going to be asking that? How do you see that developing? Sian, Gautam, would...
Yeah, maybe I'll take that first. I think definitely not tokenize everything, I think, is the answer. I think I go back to what I said earlier, you know, what problem are we trying to solve?
Okay.
What obvious problems does blockchain, does Web3 solve in this space? So tokenization needs to solve a problem, otherwise you're not improving the state of the art necessarily. That's my fundamental belief. But the good news is a lot of the infrastructure rails around custody tokenization, actually they're quite common across the piece. So you could tokenize different kinds of assets and use the same infrastructure. It's very scalable. That's why it's really interesting. But you know, the obvious ones, again, I would stress are the ones where potentially you can open up access, right? So real assets, real estate, like we talked about, where minimums are typically high, where suddenly you can open it up to a wider audience and low-end clients. I think that's particularly interesting.
Yeah, look, I completely agree with Dan that there's no particular need to tokenize every asset. There has to be a real reason and use case behind doing that. And I think a couple of properties of blockchain technology, such as, you know, your ability to program and code certain, you know, principles on certain pieces of the token.
Well, what if the code is bad?
Yeah.
What happens then?
Well, this is an important component in terms of doing regulated assets, digital assets. One is the reversibility of transactions. So many crypto assets are irreversible. So if value is lost or stolen over the past few weeks, we've seen how difficult it is to recover that value. But you can, as Gautam said, actually program the assets such that they are recoverable. And then even if you do have a bad or flawed smart contract, you can reverse the impact of that transaction. Look, this is maybe the first point of disagreement. I actually do see that we will be tokenizing everything, or at least any ownership stake. For example, in the applet that I've described, we're tokenizing cash, commodities, and securities. We've tokenized private markets and public markets. What's exciting is they all ride on the same rails. And what that means is instead of having to go to a separate marketplace to trade commodities, another one to trade securities, it's all on the same baseline rails. That means that it does settle instantly. Now the other component, we just received a patent on our compliance-aware token framework. What this allows you to do is actually bake into the token the mechanism by which it knows what it's allowed to do. What that means is you can have universal rails for all assets, and parties are only able to interact with the assets that they're qualified to interact with. It's finally a global liquidity pool is possible. Many of you know of market fragmentation, where you have, again, all of these separated markets. That's the challenge with liquidity, is that you have to go to so many different venues to conduct transactions. In the future, in the not too distant future, you'll see a unified marketplace for any kind of asset.
Unify because there was only one winner, or unify because you have interoperability? What do you think?
Because of interoperability. It's essential. There can't ever be one solution provider. There shouldn't be one distributed ledger, one solution provider. The reason is that means the end of innovation. So in fact, it's better to have open rails and constant competition. But what you want from the customer experience, it's like, I'm old enough to know the early days of Google and what it was like to have search engines where they had categorized the competitors to Google, the information space, a bunch of different ways. You had to know what you were looking for to go and find it. Google came along and made a simple experience where you just asked for a thing and you got it. This is a simple investing experience. With a wallet you can freely download, you can now get access to any asset that you're qualified. That's where the unification is needed.
At the end of the day, it's supposed to be even transparent for the end user. I think they don't really know or don't have to know. And as you were mentioning, we have the opposite of the, let's say, like the benefits that the promises from blockchain, which is a lot of liquidity, homogeneous, is totally the opposite for now, because a lot of innovation. You know, you have also a lot of competitors, I can imagine. So yeah, very much looking forward to see how we'll.
Can I come back really quickly to Dan? Dan, I think we're in agreement, actually. I think precisely because the rails and the infrastructure is common across the piece, whatever you want to tokenize, I do agree with you. I think it's about time frame. My view is if you do want to have the wider adoption, you've got to zero in on the use cases where blockchain and Web3 can apply the most added utility to that. And those are hence the why. I think we're broadly in agreement. I think it's really about time frame that we're talking about.
You know, the one thing I would add to this is that not only does tokenization potentially help with existing assets to be tokenized and then the value comes out of it, but also opens up new potential asset classes, right? The whole concept of NFTs, for instance, your ability to have digital ownership and your ability to trade that itself is a big unlock that is not possible without tokenization. So I think it impacts both existing assets, but I also think it opens up a massive market for new asset classes as well.
Gotham, stay with me for this next question. So now, for the last handful of years, people have liked to say over and over again that, you know, digital assets and cryptocurrencies are essentially decorrelated from the market. So they make an excellent hedge. You should add them as part of your portfolio for a good hedging strategy. The last year has shown that this is not the case, very, very violently, let's say that. And we are, however, seeing quite a bit of very interesting work being done, right, in areas such as, for instance, synthetic crypto ETFs or NFTs like you just mentioned, or tokenized investments. There's actual products that are coming out that people are looking into to nonetheless hedge and build well-structured portfolios. Can you tell us about some of these products that either you're building or some of these areas that you're looking around?
Yeah, sure. I think we fundamentally believe that you know, this is definitely an asset class that people need to dip their toes in. And it's important to, you know, if you are a tech investor or a Web 2.0 investor, if you're not investing in any Web 3.0 technology products, you run the risk of missing the big trends that is emerging in the technology space, which is also likely to, you know, disrupt existing business models in Web 2.0 world. So it's important to have that. The question is, how do you access it? Because not all institutions are comfortable buying tokens directly. And hence, you know, we try to offer a fund which is currently restricted to institutional investors, but it shouldn't be too far away where we are able to tokenize our fund itself and allow, you know, widespread adoption of our asset, you know, our funds, but also, you know, you're seeing a lot of ETFs coming up as well to enable access. So it's all about how do you, you know, ensure there's enough avenues for both institutional and retail investors to access this in a way that they are comfortable with.
And I think it's also a source of inspiration because a lot of innovation will be on decentralized finance, NFTs, but there's also where like I recognize like financial institutions get inspired the other way around. So we need the regulation at that level, of course, but you can see how efficient it could be, how independent it could be. So more like the platform play where a financial institution doesn't always have to be in the middle, but can facilitate that. And you can adapt your NFT with towards like financial product that will pay a fee to the issuer automatically, for instance, as a royalty kind of equivalence. So there's a lot of potential, I believe.
I think on the tokenized investment front, I think in many ways it has the potential to actually help with portfolio diversification, to answer your question directly. So I'll give you an example. Real estate is a really good one. Now, in the wealth management space, particularly for smaller clients or even affluent or high net worth clients who maybe don't have the capital to go all in into physical real estate to diversify a portfolio, when you actually look to create an asset mix, historically and traditionally in many places in the States, in Europe, in Asia, the proxy has always been real estate investment trusts, but typically you're taking on equity risk, which is actually very correlated to the state of the markets. Now, the benefits that tokenization gives you is you can actually have access to hard real estate, and you're taking on real asset risk, which historically before this new technology, sorry, not so new anymore, before the state of the art today, that would have been impossible. You can't just buy a fraction of an office building or a residential building to diversify your portfolio. But this is the power that this technology gives us.
Yeah, so the opening part of your question, Gabrielle, regarding crypto assets being uncoupled to traditional market forces, it's in fact proven to be exactly the opposite. They are hyper-coupled. The reason, they're the liquid assets that go first in times of trouble. So it's actually amounted to be the opposite, and without expert asset managers like Hervé and Gautam, your portfolio may be suffering if you only know of crypto. But if you think blockchain is only crypto, you are missing the party, because banks like HSBC, our work with our major institutional partners, are really leaning into the other benefits of blockchain, which has a lot to do with institutional DeFi. You may have seen JP Morgan's big trade recently using the first public use of a DeFi. That's the tip of the iceberg. There is a lot more that's happening behind the scenes, which give us the ability to retool a financial institution. So small DeFi smart contract teams, 10 to 12 developers, can do what takes banks hundreds, even thousands of developers and tens of $millions to do. What banks are realizing is this is the future of their infrastructure, and we see them retooling now. It's actually been blockchain's heyday if you're looking at institutional adoption over the past year, whereas crypto has suffered to some degree.
Amazing. Thank you. So I do very much need to wrap this panel up, but I will ask one final question that only one of you can answer. So whoever answers it first gets it. What is the funnest use of a smart contract you've seen?
We tokenize power. So we've got a subsidiary that works in the power exchange, and we've taken kilowatt hours and tokenized it, which allows devices to trade power usage peer-to-peer. This opens up all kinds of opportunities for carbon credits that are actually verifiable, among other things. But it's exciting. It's a crazy world, the kinds of things that you're going to be tokenizing in the future.
That is exciting, because then it leads on to, machine-to-machine payments and machine-to-machine finance. Love it, but I need to get these people off the stage now. Ladies and gentlemen, thank you so much for being here for this session. Gentlemen, thank you.